S&P 500 Index SPX, long-term, chart analysis. Last week's analysis. We previously noted the recent volatility is uncommon and difficult to navigate successfully. However, it appears the market is resolving this volatility in an upward direction. This week's analysis. The Federal Reserve's 0.5% rate cut sparked a rally on Thursday, pushing the S&P 500 Index, SPX, to new all-time highs. Our outlook remains bullish. The 200-day moving average effectively halted the selling pressure in early August. Conservative S&P 500 strategy. This strategy aims to shield investors from bear markets. Short-term declines are expected and should not trigger sell signals. In contrast, our aggressive report closely monitors short-term indicators. This conservative strategy relies on long-term chart analysis and avoids reactions based on emotions or news events. It is designed to accommodate market fluctuations without attempting to time every minor movement. The approach is decidedly long-term. We maintain a bullish stance on the Rydex S&P 500 Nova Fund, RYNVX, or other S&P 500 index funds or ETFs such as SPY. S&P 500 Index, SPX, and current chart analysis. Last week's market movements. In just 3 days last week, the S&P 500 Index, SPX, surged by 4.1% after having declined by 4.1% over 4 days in the prior week. Such volatility is not conducive to successful market timing or trading, as it often results in buying at the peak and selling at the trough. This week's developments. Following the 0.5% rate cut, Federal Reserve Chairman Jerome Powell stated, "The U.S. economy is in a good place, and our decision today is designed to keep it there." While we have reservations about the timing of this crisis-level rate cut, especially with the stock market and home prices at record highs just 2 months before the election, we must accept and adapt to the Fed's decision. Is the S&P 500 Index, SPX, on track to hit 6,000 by year-end? Given the strong economy and projected interest rates of 2%, it's possible. However, unforeseen events could disrupt this trajectory. On Thursday, U.S. stocks soared, with the SPX reaching a new record high and the Nasdaq 100 index climbing 2.3%. Investors now believe that the Federal Reserve can achieve a soft landing following the 0.5% rate cut. Interestingly, despite a bearish outside reversal on the day of the rate cut, the SPX experienced declines on Monday and Tuesday. However, Thursday's substantial rally alleviated bearish concerns, closing the week at a new all-time high. Previously, we anticipated that the recent rally would break out to the upside, given the likelihood of a rate cut by the Federal Reserve. Although the Fed may have delayed cutting rates, the eventual 0.5% rate cut seems to meet market expectations. Economic indicators. The annual inflation rate in the U.S. declined for the 5th consecutive month to 2.5% in August, the lowest since February 2021 and below market expectations of 2.6%. However, not everything is positive. Gross interest on U.S. debt has surpassed spending on defense, income security, health, veterans benefits, and Medicare, now becoming the second largest government expenditure after Social Security. This means interest expenses will soon exceed Social Security spending, becoming the largest government outlay by late 2024 or early 2025. This is a consequence of our own fiscal policies. Market-moving economic reports released this week. Retail sales. U.S. retail sales rose 0.1% month-over-month in August 2024, surpassing forecasts of a 0.2% decline. Notable increases occurred in sales at miscellaneous stores, non-store retailers, and health and personal care stores. Excluding autos and gasoline stations, sales increased for the 4th consecutive month. Industrial production. U.S. industrial production increased by 0.8% in August 2024, the highest in 6 months and exceeding market expectations of a 0.2% rise. Manufacturing output, which constitutes 78% of total production, advanced by 0.9%, surpassing forecasts of a 0.3% increase. Housing Market Index. The NAB/Wells Fargo Housing Market Index rose to 41 in September 2024 from 39 the previous month, breaking a streak of 4 consecutive monthly declines. Federal Reserve rate cut. The Federal Reserve reduced its benchmark interest rate by 50 basis points to 4.75% to 5%, marking the first rate cut since March 2020. This decision was prompted by progress on inflation and balanced risks. Housing starts. U.S. housing starts surged by 9.6% in August 2024 to an annualized rate of 1.356 million units, significantly above market expectations of 1.31 million units. This marks the sharpest increase in 9 months. Mortgage rates. The average interest rate for 30-year fixed-rate mortgages declined by 14 basis points to 6.15% in the week ending September 13, 2024. The lowest level since September 2022. Unemployment benefits. The number of unemployment benefit claims dropped by 12,000 to 219,000 for the week ending September 14, below market expectations of 230,000, reaching a new 4-month low. Despite this decline, the claim count remains higher than earlier this year as the labor market has softened since its post-pandemic peak. Conclusion. The SPX position in this strategy remains bullish. Aggressive traders should consider the Rydex Nova S&P 500 Fund, RYNVX, or other bullish S&P 500 index funds or ETFs such as SPY.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.